Good morning, everyone. On behalf of KPMG, I'd like to welcome you to our latest webinar in our tax leadership series, which will focus on the EU ATAD interest limitation rule. The Department of Finance opened up a public consultation on how Ireland should implement the rule with the release of a feedback statement back in late December. This built off the public consultation that they held back in November 18, both on the interest limitation and the anti-hybrid rules. So you can feedback any comments that you have on this consultation up to the 8th of March. And I would certainly encourage you to make a submission if possible. It is without doubt that, in these consultations, the voice of business is weighted heavily in working through how they are going to configure and bring in the rules. So I suppose the timing of today's webinar is to equip you and make you aware of the key elements in the consultation so that puts you in a position to make a submission if you do want to make one. We will be making a submission ourselves. And so to the extent that you aren't planning on making a submission, please feel free to feed in any comments that you have to ourselves, and we will certainly look to reflect those as best we can in our own submission. The department will hold another consultation in the middle of the year, building off the output from this consultation, where they will be proposing various legislative approaches for implementing the rule, and then the plan is in the finance bill later in the year that the draft legislation will be finalised and will take effect from the start of next year. Ostensibly, the rule is quite a simple one. Interest that's in excess of 30% of EBITDA would be restricted in terms of its deductibility. But like all things, there's a lot of complexity and detail to navigate through. We certainly would be advocating as much optionality and flexibility as can be left and maintained in the rules themselves. That maintains the case, or that remains the case, because different businesses have different activities, their capital structures are very different, and you don't ultimately want to have businesses with a certain set of facts be constrained or have to align themselves with a set of rules and a set of reliefs that aren't best suited for their needs. But ultimately, it will be businesses that will need to model out how this is going to impact them, and I would encourage you to engage in that sooner rather than later, so that you get a good handle on how this interest limitation rule could potentially bite in your business, the reliefs, and how, which reliefs would offer them the most relief for you, and obviously that could be fed back in the responses to this consultation. Just on some housekeeping, the format for today's webinar is a presentation by two of our partners, Alan Brommel and Gareth Bryan, who will cover the key elements of the consultation and also reflect both the financial services and non-FS markets and how it could impact on those. This will be followed by a Q&A. This webinar is being recorded, so will be available to view afterwards should you wish to take a look at it again. Please send through any questions that you have through the Q&A function that you will see at the bottom centre of your screen. The questions will come directly into myself, Alan and Gareth, and we'll do our best to get through all of the questions, but to the extent that we don't, we will certainly come back to you afterwards with some responses. So that's it for me. Thanks again for your attending the webinar. I'm going to hand it over now to Alan to kick things off. Alan.
Thanks, Tom. Good morning, everybody. Just as a reminder, the EU Anti-Tax Avoidance Directive, or ATAD, imposed an obligation on all EU member states to bring various anti-avoidance provisions into domestic law. So interest restrictions is the last of those measures. We're already dealing with and grappling with new legislation in the area of anti-hybrid mismatches, CFC rules, and new exit charge provisions. It was originally signalled when ATAD was signed by Minister Noonan at the time that Ireland would avail of flexibility not to introduce interest restriction legislation until 2024, which was the latest date by which member states could bring in these rules. However, various pressures in the intervening period has meant that the department has accelerated its plans around that. We did get a stay of execution, essentially, that it looked like we were going to be dealing with these rules in 2021, in fact, but various things, not least the pandemic, got in the way of that. But there's no doubt these rules are coming in the finance bill later this year and will become effective for 2022. Today's focus is general. There will be some considerations which are sector or even company specific. And as Tom said, we'd encourage you to engage with your KPMG contact or Gareth and I in relation to those issues. And we thought it was really important to hold this webinar now rather than when there is draft legislation on the table, because quite frankly, that will be too late for a lot of companies to both model the impact of this and decide what they need to do to deal with it, but also to have their views heard and ensure that the regime that Ireland introduces is as flexible and as broad as possible to allow different companies to avail of different options. In terms of the framework, as Tom said, what we're talking about here is a new restriction to be introduced, which is essentially like thin cap, which will limit the level of interest expense which an Irish company can deduct against its taxable profit. Interest is defined very widely, which Gareth will cover in a few minutes. So it's broader than just interest being paid on a loan. It extends to other financial costs. And one also has to consider what is interest income, because what we're talking about here is net interest cost, net of income. As we know, Ireland has a complicated group system for corporate tax purposes. We also have different tax rates for different activities. So it means that the department and the Irish Revenue have a tougher job than some other EU member states in writing a set of rules here that's workable while still meeting our obligations under the directive. All is not lost. There are a host of exemptions provided for under the directive, which the consultation document does signal Ireland will take up, and we'll cover those later. It's important to note that third-party interest is within the scope of these rules. So if you think, well, I've got no related party debt, I've got no debt from associated entities or for shareholders, therefore I don't need to think about that. That is not the case. However, it is expected that the effect of various worldwide group provisions, which we'll speak about later, will be to give relief for external debt, essentially. It's also important to note that there are some, grandfathering arrangements proposed, which may mean that interest on certain loans entered into prior to ATAD being signed in June 2016 will be carved out from the rules. This consultation ends on the 8th of March, so we still have a good bit of time. It's the second one, as Tom said. There was one in November 18, which we submitted a response to. There are two phases to this consultation. The second one is expected later this year and will mainly deal with the various group measures, but also I suspect will build on a lot of the responses that the department receives in response to this particular phase. Those of you familiar with the Irish tax rules might ask the obvious question, my tax comp or my interaction with Irish tax advisors is complicated enough when it comes to interest deductions. Are you telling me that we're now going to have something else overlaid on top of that to complicate things even further? And unfortunately, that appears to be the case. And since 2018, we have been making the point at the department that this is the optimum time to redesign Ireland's entire regime. Given that it would seem if we keep what we have and we bring in ATAD style restrictions, we'll actually be going a lot further than other EU member states. However, for now, the Department and Revenue are resistant to that. I think they see it as useful that Ireland can say, we have plenty of measures in place to prevent erosion of the Irish tax base. And similar to the way other provisions such as the CFC rules and anti-hybrid rules have been introduced, it is likely that that is seen as useful in ensuring that our sacrosanct 12.5% tax rate is capable of being defended at all times. Having said that, the consultation document does signal a willingness to move. One of the questions is what limited adaptations might be made in the Finance Bill 2021. And another question is what further adaptations might be made later to Ireland's interest deduction rules. And we would have plenty of thoughts on that, which we can talk about later. So moving on to the next slide.
Thanks. I'm going to pick up now on the question of interest. Before we get into how these rules are going to apply in practice, key first question is, what are we talking about here? What do these rules apply to? And that's relevant both to the expense side of things, but also to the income side of things, because the rules apply to a net borrowing cost. So you need to take account of both income in, that is of a debt type, and income going out. And indeed, Revenue of Finance have said they intend to have perfect symmetry between those. So you shouldn't have a mismatch. You shouldn't have something that doesn't count as interest income, but is an interest expense. So although we use the term interest loosely during our presentation today, the rules are designed to apply to things that are like interest, even if they are not legally interest. The directive says that it should cover interest and things that are economically equivalent to interest. And then they list out, shown on the left-hand side of the page here, a series of things that should be included, which is seen as a minimum standard. And within that, the list includes things like finance leases, capitalized interest, FX movements as well, amortized interests, notional costs, transfer priced interest. So all of these things are supposed to be included on the directive. In the consultation, they've included a proposed definition. It says it would cover interest and things economically equivalent to interest, including, and then it lists out discounts and then payments that are equivalent to interest under arrangements where it would be reasonable to consider that it's like lending money. So a very broad catch-all type framework rather than enumerating all of the specific items in the directive. And then finally, they add on to that debt financing costs, so guarantee fees, arrangement fees. It's not a comprehensive list, so it says it includes these things. So it does lead the possibility of a slightly broader interpretation. I think a key question from our point of view is would it give more certainty to everyone to actually enumerate all of the things that are in the directive, even if that also means including the catch-all phrase that they have there, but it might at least give certainty, which is something Ireland has always tried to do with its tax system, is provide certainty around how the rules apply. And rather than having an argument to say, is a finance lease equivalent to lending money, why not include what the directive has already mandated should be included? And that would take out uncertainty around things like hedging instruments. Are hedging instruments covered? It's a bit unclear. A really important point that's not addressed, and we think is going to be relevant for lots of our clients and lots of you, is for businesses that are engaged in the provision of credit. So that would include banks, and there might be an exemption for banks, and we'll talk about that later, but it includes a much broader context here when you think about what's to be included. So people who are in the business of providing consumer credit, HP, finance leases, car leases, anyone engaged in those businesses, they obviously need to think about this. And there's a key question: if that's your business, if you're providing credit, you're probably fair valuing your book of assets, whether they're loans or finance leases or HPs, on an annual basis as part of your accounting exercise. So the question is, what happens in that fair valuing exercise to movements up and down of fair value on those investments, on those assets? Typically that fair valuing, if you were maybe a dealer in securities, you'd have to think about this too. There might be spot rates that you can look at. But if you're fair valuing a book of finance leases, you probably look at your projected cash flows on those leases and what do you expect to receive on them. That fair valuing wouldn't often, as part of the exercise, distinguish between principal and interest. So if we have to split out those fair value movements to the bit that is relevant to the interest fair value and not to the principal fair value, then you could have a very complex additional piece of compliance to be done, particularly for a large book of business, and potentially you have to do it on an asset by asset basis. So I think there is a point there if we were engaged in the provision of finance as a trade and as a business to say, really, what you need or what you would want is to include in your interest income that all of those discounts, those fair value movements on your assets, the financial assets where the interest would be caught, include those fair value movements to get a simple, workable solution. The quid pro quo, of course, is that you have the same on your own debt financing, you'd have the same provisions. But those are some key questions coming out of the observation, coming out of the consultation. So hand back to Alan.
Yep. So just moving on to the next slide then. The consultation document sets out a proposed 7-step methodology to determine not only whether there is to be a restriction and how much, but also to identify so-called headroom or excess capacity to be carried forward. That is, to the extent that in a particular period, interest expense does not reach the 30% level. And it's also necessary to have provisions to identify excess interest and determine how exactly that gets treated on carry forward. Again, the design of this is complicated by the fact that we have different tax rates, thus bringing in the need for a proposed credit-based system. So the methodology essentially is that under step 1, one calculates a corporation tax liability under Norman rules, applying all other tax considerations such as loss relief, existing rules around interest deductibility, etc. Steps 2 to 4 work out the interest in scope and the net interest expense, net of income. Step 5 takes off the proposed de minimis amount, which we suspect is going to be €3 million. We'll cover that later. And also deducts out legacy interest expense, which again we'll cover in a while, but that's interest attributable to certain loans that may be grandfathered. EBITDA appears to be the tax adjusted profits, but more clarity is required on that. Step 6 then works out whether or not your borrowing costs that is arrived at after steps 1 to 5 does indeed exceed 30% of EBITDA. And to the extent it does, then the proposed mechanic to claw that back is to tax that amount at the rate of tax of 25% as a case 4 charge. And then under step 7, you carry forward any restricted interest as a credit or as excess capacity. So there are a few important points on this. The test gets applied in the company or companies that use it. So for example, if you have a company with no income but interest expense creating a loss, then you look at the company that is actually claiming the group relief. One looks here at the Irish local group in total. So you've got to determine what entities are in the local group, more on that later. And you've got to examine the net interest position across the Irish tax group. The restrictions imposed by taxing a notional amount at the effective rate applied to profits it reduced. The thinking here being in taxing it that it's an adjustment to the tax liability to right size the interest expense in line with the ATAP principles. One issue in our view, which I think Revenue and the department are aware of and have indicated they're sympathetic to and maybe dealt with, is the fact that it appears right now under what's proposed in the document that one cannot offset other reliefs against the notional tax. So for example, losses forward to the extent that they would be available to cover this case 4 charge cannot be used, which doesn't seem equitable from our perspective. But as I said, we expect some movement on that in the course of the responses on the consultation. Gareth, I think you have some additional observations on this one.
Yeah, certainly. Thanks, Alan. And that case 4 charge approach, I think it is driven in part by a desire by finance and revenue to have a system that is as flexible as possible. So by having a case 4 charge, you're imposing a cash tax liability, which you add on at the end of your tax computation. So rather than blocking a deduction. And why is that sensible, or what does that achieve, you might ask? And indeed, one of our participants has asked that question through the Q&A chat. The thinking here is that by having a credit system, you'll have greater flexibility for taxpayers, because under our existing rules for other reliefs like losses, charge relief and so forth, there are restrictions around their use. So losses forward from a trade can only be used against the profits of that trade. Group relief can only be claimed in the year when that deduction arises and can't be shared between other group members in future years. The idea is that by allowing potentially, before you get to a tax bill, relief for other deductions where possible, then you are using more restricted reliefs first and having cash tax at the end. Now, I think there is a realization, Alan, as you said, by revenue that we need to make sure that if you're going to have a system like this, that any tax charge can be fully credited, get with any other credits that are available if that's relevant in the circumstances. But that is the logic behind this idea. So although it seems a bit more complicated, there is a positive intent behind it, which is to try and give flexibility. But in doing that, in part of this methodology, there's an unusual feature of how they've come up with their proposal, which is step 4 here. So instead of simply saying, well, let's work out your interest expense and work out your interest income, and if you've got a net interest expense, then take that as a percentage of EBITDA, which is step 5, and figure, 5 and 6, figure out the restriction. Instead, they've said, well, look at your net interest expense first, or look at the interest expense first, and figure out, does that push you into a loss-making position? So without the deduction, would you be in a loss-making position, or are you getting into a loss-making position because of this deduction? And they're saying, well, only go forward with a restriction in the current year where you're actually getting your tax down below 0, or increasing your losses if you're already below 0 because of the deduction, right? So if you're not in a cash tax position without the interest, well, then we won't impose any restriction this year. Instead, we'll defer that until when you ultimately use that deduction for the interest, or credit for the interest in the case of group relief, some group reliefs, which of course will mean that you'll need to track that component of your reliefs, because if you don't impose a restriction on interest because it doesn't drive you into a cash tax position, well, then that deduction essentially forms part of your losses forward, and therefore a component of your losses forward is going to be form part of this interest and be subject to a restriction when it is used. And another feature of this proposed structure is that there is this idea, which we'll come on to in another slide, about where you are below the 30% limit. So you haven't used up all your capacity in 1 year. You can carry that forward and use it in years when you are above 30%. So that it averages out over time. There is a risk with the credit system, and we'll demonstrate it, whereby actually, because the carrying forward provisions in the directive say you can only carry forward unused capacity for 5 years, but unused deductions indefinitely, you could find yourself in a situation where in fact you have capacity that is lost, the 5 years elapse on it, even though had you had a deduction system rather than a credit system, you wouldn't have lost that capacity. So I think that needs to be accounted for. And maybe these points are best explained through an example. So if we go to the next slide, and I'm going to just walk us through a simple example. So here we have an equipment leasing company, and for years 2022 to 2030. So for all of those years, we have very simple lease rentals, $1 million, operating expenses of 200,000 throughout. So we have an EBITDA throughout of 800,000. With capital allowances then, same amount every year, and that pushes us into a tax loss every year of 100,000. So in year 1, 2022, we have an interest expense of 400,000, and in the figure there in red beside it is that as a percentage of EBITDA, 50%. But we're already in a loss position without this interest expense. So this idea in step 4 is, well, we won't do anything this year. We'll have no impact because we're not using the interest to reduce a cash tax liability. So as you'll see, yellow is going to track our interest, the impact of our interest restrictions. There's none. Instead, we've losses forward of 500,000, but within that, we're going to have to track, which is really step 5. We're going to have to track how much of that relates to the interest deduction, and that's 160,000 in this case. That's the difference between 50% of EBITDA and the 30% cap of EBITDA. 2023, similar, except we've got a higher interest expense, but again, so we're at 50% of EBITDA as a percentage. But again, we're already in a loss-making position, so we'll have no impact this year. Instead, we'll just increase our losses forward to 1,050,000, and we're increasing our interest restriction component of that, 370, down in blue. So 2024 onwards to 2029, it's the same, except that our interest expenses fall into just below 30%. So every year, now we have 2% unused capacity. And in 2024, we're already in a loss-making position. So we're not going to use any of our restricted interest component from prior years. So there's no impact again. So we now have both restricted interest component is there, it's static, 370,000 cumulative in 2024, and that carries on onwards. But each year now, down below that in peach, you can see we are building up unused capacity for this 2%. Each year, 15,000 added on, added on, added on, and we're rolling that forward. We get to 2030. Very early in 2030, we sell this asset, we do no more rental income, no more expenses. So we have zero EBITDA, in fact, in that year, and we have a balancing charge on the sale of our asset, 3.4 million put in here. Okay, so that's great. We've got 3.4 million, but of course we've got 3 million of losses forward. So that's great. Reduces our tax bill down to 400,000, tax at 12.5%, 50,000. But we have to realize within that 3 million, we have been carrying forward a restricted interest component. And we've used all of our losses, so now we have to claw all that back, right? So we are using that interest deduction effectively in 2030, and therefore we have to have this catch up. So it's only a deferral. So we're going to have to add back on, essentially, a tax bill. We have to tax ourselves on 370,000. But of course, we've also got spare capacity, which we've unused. So we can use that to offset this impact. And here we've reduced it by 75,000, leaving us with a 295,000 bill taxed at the notional case for charge, gives us a tax charge of 36,000. And so our total tax bill now is 86,000 instead of 87,000 instead of 50,000. But of course, we now have a credit. We've now actually triggered a cash tax bill of 36. So we now have a credit that we can carry forward to future years if we have future income. So that demonstrates what we're saying here around this step 4, that you actually have no impact until you were deemed to use the payment. And they're saying the same would follow for group relief and charge relief and other credits and so forth. The other thing to point out here is this thing around capacity. Could we lose capacity? You'll see we started getting capacity in 2024, but we didn't use it until 2030. So our first year, 2024's capacity had already lapsed. 5 years has passed. So instead of getting unused capacity of 90,000 in 2030, we've lost 15, so we're down to that 75,000. Had we just blocked deductions all the way along, just said, okay, in year 1, 2022, we just won't get a tax deduction for that 400,000, and instead we'll reduce our losses forward, we wouldn't have had the same issues, potentially. And you would have had potentially had the ability to avoid that lapsing credit, because we would then have had potentially a tax credit created in year 1, and in 2024, 25, 26, with spare capacity, we could have started clawing back that credit. That would have been limiting, because it would have meant we're converting that what would have been a credit is now a deduction. It's trapped, at least in trading losses, they're going to be carried forward in the same trade. So it's less flexible, but it means that you don't lose the capacity. So I think if we are going with the credit system, we need to find a creative way to make sure we don't lose capacity in these unusual circumstances. So I think I'll hand back to Alan. Oh, sorry, I think one more slide before we go from me.
Gareth, what that does show, though, is that, back to the point made at the start, you know, you don't really know how this thing is going to affect you or how it will play out without modeling it, not only for this year and next year, but you actually got to look at your activities over the typical timeline. You model things from a tax perspective. The hope is that we'll catch fundamental things like this, right? But no doubt there'll be lots of company and sector specific issues like this that you know, with the best will in the world, finance and revenue system will not be able to capture. So it's important not only in consider the impact on you, but also feeding back in, because I think they do appreciate that feedback, in particular when things are unintended.
Exactly, and I do think this is unintended. I don't think they intend this, but I think we need to help them see that and to point out how it might be remedied. So I do think there's an openness there to finding solutions to these issues once they understand what they are. I just want to mention here one slide on this carry forward and carry back of blocked deductions and unused capacity. There are actually 3 options in the directive. One is just carry forward the unused deductions for use in future years when you have capacity. There's another one which says, well, carry back the unused deductions 3 years and carry forward indefinitely. And the third option is, which is what our model is based on, carry forward unused deductions indefinitely, but capacity is capped at 5 years. I think there's a broad consensus forming around option 3, but the consultation asks, you know, which which of these options would be best for us to take, and how would we implement them. As I say, I think while there is a consensus around option 3, it'll be important to make sure that if we're going to use a credit system, we don't end up in a position where we have lapsing capacity where we wouldn't have a lapsing capacity in a deduction-based system. So, Alan, I will now hand back to you.
Yeah, so just moving on to the next slide then. The next slide is, yes, this is the one. So as I said in the introduction, the directive does carve out various things in terms of exemptions. So the first one, and it's something that you'll see in a number of EU member states that have already implemented these rules, is a de minimis, so an amount of interest that one can deduct regardless of your level of profitability. The directive provides for a maximum of 3 million. Some countries have gone with 2. The document from the Department of Finance is suggesting that we will go with 3 million euros as well. The way they've drafted it suggests that the first 3 million of interest expense will just not be taken into account at all for the purposes of the calculation. So it's not a cliff effect. If you're over 3 million, it doesn't mean that you don't get any amount exempt. Just say 3.5 becomes the interest amount to be considered. How to apportion the 3 million de minimis across Irish group companies is something that does require a bit of work in the drafting, however. Secondly, there is a relief for a concept which is a standalone entity, which needs to be defined and exempted. It's viewed as a simplification measure, the effect of which is to say that if you have an entity that's a standalone entity, it just doesn't fall foul of these rules at all, so long as it meets the definition of a standalone entity. The rationale for this is the view under the directive, I guess, that excessive payments from an interest perspective take place primarily between associated entities by way of related party debt, shareholder debt, etc. So if you're a standalone entity and you're not in a group and you don't have associated entities, it's less likely that you're going to be in receipt of funding of that nature. So clearly this is to be welcomed, but there's a risk in how they implement it that it becomes so unworkable that nobody can avail of it. So that is the key, right? Defining what exactly a standalone entity is. So it's suggested that it would be defined as an Irish tax resident company, which is not a member of a worldwide group, which takes its meaning from accounting definitions, has no associated enterprises, and does not have a foreign PE. So if you're not in a worldwide group, essentially you're not a, you may be a standalone entity. Worldwide group is defined by reference to whether or not as a company you're consolidated in under an ultimate parent for accounting purposes, and onto a parent being an entity which is preparing consolidated accounts under GAAP, or would be required to do so if adopting IAS, and which is not part of another consolidation. And all entities are fully included in that consolidation. So it'll be quite clear in an example where you have Tom Jones owning Tom Jones Limited, that Tom Jones Limited is a standalone entity. However, this could get very complicated, for example, in typical private equity holding structures. The document picks this up too, noting that it's a potential area where apparently unrelated entities are in fact controlled by the same investors. We think that the fairest approach, which probably strikes the right balance, is to look all the way through to the extent possible to identify to what extent there are investors at the top of the structure holding more than 25% as ultimate investors. Otherwise, we may have situations where, for example, 2 portfolio companies in a fund are in a group for interest restriction purposes and are not standalone entities, notwithstanding that at the top of the structure there are no common 25% plus investors in the structure. Gary, I'm not sure if you had additional comments from an asset management perspective.
Yeah, I think this question that has been posed in the consultation is actually really important from an asset management point of view for that very reason. It wouldn't be unusual to have some kind of partnership structure for private equity investments, and that partnership vehicle might invest in multiple different entities on a kind of separate basis. So it might have stakes in lots of different companies, private equity stakes, private venture capital stakes. And the question becomes, should they suddenly become associated? They may not even know that they're associated just because they have, somebody who has 25% or more of their equity might also have 25% or more of the equity of another entity. So there's the practical issues around how would you even know this and what certainty there is, but also around whether that really makes sense. If that partnership is reflecting investment by a large number of investors, then it doesn't seem to make sense that you would suddenly treat those two independent entities as connected, where you wouldn't. If the partnership was not there and you just happen to have a common investor base but widely spread, you wouldn't be taking those together in the normal sense. So it does seem that the logical thing to do is to look through a partnership structure and to see, is there an investor or investors with a large 25% plus stake in the relevant entities, and make the determination at that level. Same would go for any kind of investment trust structure. Similar analysis, I think, can be argued. And orphan structures would be important too. Orphan structures are used in lots of asset finance. The orphan entity itself, the trustee might be a corporate. So it would be important that a corporate trustee of an orphanized entity doesn't suddenly stop it being a standalone entity because it legally has the shares in that entity. So I think it'll be important to make sure that in those contexts, you don't get caught with standalone entity status inadvertently.
Thanks, Gareth. So moving on to the next slide then, in terms of the exemptions. Mentioned earlier a grandfathering provision. So the 17th of June 2016 changed all of our lives irreversibly with ATAD being signed, but any loans entered into prior to that date, the consultations document is suggesting that Ireland will take up the scope under the directive to exclude those loans, interest on those loans from interest, which is taken into account for the purposes of the calculation. There is some commentary on modifications because, it is rare that 5 years after a loan being entered into, there may not have been some amendments made to the loan to cater for something. So this is in particular, this is relevant over the last 12 months or so, as a lot of both third party and related party financing agreements have had to be amended to take account of LIBOR reform. So the consultation document says that will not be considered a new loan for the purposes of this grandfathering, but it's not clear in the suggested drafting exactly how they're going to achieve that. So that does need to be tightened up. What is very unclear, which will require consideration because it's probably a relatively common fact pattern, is what is the position in relation to facility agreements that may have been signed pre-June 2016, but which provides flexibility for multiple drawdowns, given rise to drawdowns under that loan facility agreement, both pre and post 2016. Are all drawdowns grandfathered by reference to the fact that the agreement was signed before June, or is there some type of pro rata allocation required on your interest by reference to drawdowns pre and post? Again, that just remains to be seen. We assume changes in loan provisions, such as provisions dealing with security arrangements and covenants, are okay, but again not clear. And clearly, we would be striving to ensure that there's a broad range of modifications allowed to a loan agreement, as would be the case commercially in a lot of instances, without it constituting a new loan. I suppose I would say it does mean that to the extent that provisions in loan agreements are being amended between now and the end of the year, regard is had to that point. The next exemption available under the directive, which again it's signalled will be introduced in some shape or form in the Irish legislation, is what's called the long-term public infrastructure exemption, or the public infrastructure benefit exemption. It's also known as. Most countries with interest restrictions have this. The rationale for that being that large-scale, capital-intensive infrastructure assets such as roads, schools, railways, hospitals are just by definition very highly geared with both external and, in some instances, related party debt, because the capital expenditure requirements are just so large. I suppose there's a recognition that if there was not a carve out for loans on such assets, then the reality is those assets would just not get built, which is not for the public benefit. Or certainly, if they were getting built, the impact of interest restrictions would impact the pricing of such projects. So the key here will be how do they define the assets that come within the scope of this exemption. No criteria is proposed, but the suggestions are sought. So we've given this a good deal of thought, and we think clearly it needs to be as broad as possible. It should define large-scale tangible assets with a life of at least 10 years. We think it should include infrastructure assets procured by a public body, but also infrastructure assets used in a regulated activity overseen by a public body. It may also include defined property assets rented to third parties, given Ireland's need to invest in property to meet economic and social policy objectives. So what all of that means, for example, is that maybe renewable energy projects and social housing assets should be considered for the purposes of this exemption. It's really important, we think, that it applies to both third party and related party loans, because structurally it's very common for investor equity to come in by way of loans, and lots of investors in infrastructure assets such as pension funds would see an attraction in that income flow, and structurally they would see benefit in both a debt and equity mix into these assets. Finally, I think it needs to bear in mind typical holding and funding structures, under which it is very common that the asset may not necessarily be in the same entity as the entity that has the loan. So perhaps the debt will be in one entity, which will be flown down into another entity as equity to fund the capital expenditure. So it's important there's flexibility to cater for that as well. And finally, as with the definition of interest and Gareth's comments earlier in relation to the directive, perhaps it might make sense to actually publish a list for certainty, because it's given the importance of the issue, it's probably not one that should be left open for interpretation. So moving on to the next exemption, which is, I think, Gareth, you, given the financial services emphasis.
Yeah, thanks, Alan. So separately within the directive, there is a provision that says that member states can choose to exempt completely from the rules financial undertakings, which they define as including credit institutions, so including banks, obviously, regulated alternative funds and fund managers, UCITS funds, occupational and state pension schemes, insurance and reinsurance companies, and then central securities depositors and OTC derivative counterparties. And the broad logic that is set out in the directive is that, well, these are probably not modes for tax avoidance through debt stripping. That's the assumption. Whether it's correct or not might be debatable. But what the consultation says is, well, should we adopt these exemptions, and how should we define financial undertaking? So there are some interesting questions there. Can Ireland just take some of these? Does it have to exempt all financial undertakings or just some? I would say the directive is capable of interpreted to say you could cherry pick if you saw fit. Question, is there a basis to include subsidiaries of these entities if they're not themselves subject to not themselves regulated in the manner described? So if you had a bank, let's say a property rental subsidiary, so it might have an investment property that it rents out as a subsidiary, is that subsidiary included or not? If it were not included, then there's an important question there as to whether or not these exemptions are more of a hindrance than a help. And it'll depend on the particular fact patterns, but if you had, say, a bank and it had net interest income, then if it had a property subsidiary that has a net interest expense, which you might expect it would if it had some interest costs, then if you count those as a group, we'll come on to group provision shortly, but where you can include things within the same group, you might say, well, I've got positive capacity, I've got positive net interest income in the bank, and that could shelter my net interest expense in the property subsidiary. But if you exempt the parent, then you potentially lose that capacity with respect to the subsidiary. So important practical question there about whether or not subsidiaries be included or not, and if they're not, that could be worse potentially. And then you have to think about, and we'll come on to some of our group reliefs, but there's a really important point which says, is if we do exclude some of these financial undertakings, but not other entities in the same group, if you're trying to apply some of the group type reliefs, then how do you do that in practice? How do you strip out that part of the group that is the exempt undertaking? How do you carve that out in practice so that you don't lose the benefit of the reliefs because it's too difficult to actually carve them out? So there is a practical, really important practical question there as well. And if we go on to the next section, actually, we're going to talk about the group mechanics. So if we go on to the next slide. So there's two group concepts included within the directive which are separate and need to be thought about separately. So firstly, there's a concept essentially of a local group, that is a group within the same territory, so in Ireland in our case. So when the directive was being framed, it was obviously pointed out that some countries, and France might be a good example, have tax consolidated reporting. And that is, instead of each entity in a group filing French tax returns, you can have an arrangement, sometimes some countries by election, sometimes it's mandatory, whereby all of the entities within a defined group actually file an aggregate return, a net return. So this consolidated tax return is filed by one member of the group and it taxes all of the group profits. So against that backdrop, obviously it made sense to say, well, look, if we're going to apply these rules, if you're going to have consolidated tax reporting, we'll then apply these rules to the consolidated group. So I think that makes sense. The question, though, comes up then is if you've got a country like Ireland, which doesn't have consolidated tax reporting, you want to make sure that there is some fairness between the fact that somewhere like France can apply these things at a group level, whereas if you applied them all at an entity level in Ireland without any sharing of the benefits or restrictions or capacity, you could actually find yourselves in a worse position at a national level. So there is provision in the directive to allow for effectively a sharing of capacity and a sharing of deduction credits in our system, but unused deductions between the group members. But there are practical questions around that, and that's in the consultation. How do we define a group? You could use our definition of loss groups, which would mean that our ability to share would be nicely aligned with our loss rules. But that's not going to be as broad as, say, an accounting group, which would include maybe more entities. Particularly as our loss groups are the 75% threshold, say, rather than a 50%. So you might find that there are entities that are not in this group, but are included in your accounting group, and that's relevant for some of the other reliefs, which we'll come on to. I suspect we'll have something imperfect here. There's going to be no single best answer. I think our view is we need something that is practically capable of being implemented in a simple manner, and that we can track things within the group easily. Questions on how do you deal with a JV or consortium, and again, that depends on your definition of group. They are dealt with through our loss group rules and their clear standing. So question, would we have something different? Should this be optional or mandatory? And if it is an election in basis and an election out basis, what do you do when people elect in or out and you've got group capacity forward or unused deductions forward? How do you merge those into a single group? If it is mandatory, on the other hand, you might find that you've got two businesses that have a common parent somewhere, but those businesses are run completely separately. And now suddenly their tax compliance is thrown together and they're forced to cooperate and deal with these things at a group level. So mandatory, that could be inconvenient, particularly for some big international groups. So there's lots of kind of practical questions there. And as I mentioned earlier, financial undertaking exemptions, how do you carve them in and out? And how do you allocate the deductions and capacity between group members? What kind of choice do you have? I think our main point here is we need something that is practical, sensible, pragmatic, that can be implemented without increasing enormously the burdens from a compliance point of view. That's going to be the key issue, we think, even if it's slightly imperfect in some ways. If you have a system that is too notionally perfect, but it means that you can't implement it in practice, that's not going to be very useful. And a good way of illustrating that is one of the questions in the consultation is, look, if you have a local group and you've got intergroup transactions, when you're looking at if you did a group EBITDA calculation, should you do group EBITDA rather than an individual entity EBITDA and add it up? Should you do a group one and deconsolidate intergroup transactions so that they're eliminated? There might be some benefits to that in some cases, but it's going to make it really, really complicated to essentially recompute all of your profits from under tax rules, because it's tax EBITDA, remember, and have to deconsolidate to like an accounting consolidation, strip out transactions. That'll be really complicated. So whatever the benefits, they may be outweighed by the practicalities. If we go on to the next slide, this is the other concept of groups, which is separate in the directive, and it looks at a worldwide accounting group. And essentially what this says is, look, if you've got genuine third-party debt and you're not, and therefore not internal shareholder debt, and of that third-party debt, you're not disproportionately pushing it into one jurisdiction over another, well, then that should be fine, because that's genuine debt. and we shouldn't be putting restrictions on that. So how do you figure that out? And they've given two options. Under one option, it says look at the profit and loss account, look at your worldwide accounting P&L, and look at the third-party interest as a percentage of your worldwide group EBITDA. And if that's higher than 30%, then that's fine. You can apply that higher percentage across the group. So let's say it was 30, it went up to 38%, you then can apply a 38% threshold. It's not absolutely clear from the consultation whether or not that also means that if you've got spare capacity goes up to 38%. We assume it does, but that's to be clarified. Option 2 says, no, let's not look at the profit and loss account. Let's look at the balance sheet instead. So you look at your worldwide group balance sheet and you look at the ratio of equity to assets. So why would you look at that? Well, they're essentially saying, well, your assets must be funded with equity or with debt. So equity being the flip side of debt. And what they've said is, look at the group position on equity to assets and therefore implicitly the group debt, and then look at the individual entity level. And if your proportion of equity to assets at an entity level is as good as or better than the group position, well then there can't be a disproportionate amount of debt in there compared to your group's external debt. So if you can meet that threshold, we'll have no restrictions whatsoever. Just a complete exemption for that entity in those circumstances. And in fact, they do allow 2% leeway, so they can be within 98% of that position. So consultation says, which of these would you prefer? We believe actually, and we've lobbied on this previously in the first round of consultations early last year, we think that the directive actually allows for both options. There is sympathy for that there, and that is being thought about, but they have said, look, if we can't have both, which would you prefer? Bearing in mind the other factors that are there. And then some questions around, well, what's in a group? What is third party for third party debt? What about standalone entities? They could be connected, but maybe they're not in the consolidated group, but maybe you've got maybe 25%, but you're not consolidating. What about other kinds of related parties? What about JVs and so forth? We would say, look, again, you need something that's practically implementable. So if you're going to start with an accounting definition and then force modifications on it, I think that's going to be very, very difficult, particularly for very large international groups, which could have subsidiaries all over the world. So trying to figure out, could I have, what would be the equivalent of an associate in, 10, 20, 30 other jurisdictions and have to do that on a global basis would make it really, really difficult. So we think you need to take a simple accounting analysis, even if that's a little bit imperfect. The other question, really important question they ask is, when you're looking at the P&L, the first option we've described, does that EBITDA need to be the tax measure of EBITDA? Which tax measure of EBITDA is how the restriction is applied, or can it be the accounting one? Again, we would say it has to be accounting. If you would try to apply a tax measure of EBITDA, it means you're recomputing your global profits for everything in your group using tax principles just to get this extra relief in Ireland. And that just won't be done, other than in maybe very limited circumstances. So if you went with that kind of approach, we think you effectively make the relief unusable. So I think that is actually a really important point for groups in the consultation to make sure you retain that flexibility. So I think we've covered quite a lot there. So I'm going to ask Alan just to step back in and maybe wrap things up before we do some questions. Oh, sorry. Actually, I'd forgotten we were going to do just a quick example as well before we get to the Q&As. So just to illustrate this worldwide accounting group concept and the two options that are there. So the first option, as I said, looks at the profit and loss account. So in that, let's take this example. We've got an Irish holding company and an Irish operating company. We've got third-party debt, which we lend intergroup then down to the Irish operating company. And we say, okay, let's assume the Irish company has EBITDA, as we tax EBITDA, of 50 million and interest of 20 million. That gives you 20%, a 40% ratio, which is above our 30% threshold. So you would have a restriction in those circumstances, and you'd cap out at 30% of EBITDA, which would be obviously 15 million. But let's say that at a group level, the only other EBITDA in the group is in the UK. So at a group level, then we say we've got 25%, 25 million EBITDA in the UK. Add that to our Irish EBITDA of 50, gets us to 75 million at a group level. We're assuming that the third-party debt, we may have used some for other purposes, we'll assume it's at 27 million. The ratio then at a group level is 36%. So that says actually in Ireland we can increase our threshold from 30 to 36 and therefore increase the deduction from 15 million to 18 million. If we then take the next slide and we look at the balance sheet approach using a similar position, and we say, okay, let's look at the balance sheet. Again, the initial points that we have a restriction under the basic rules, which we're at 40% of EBITDA, but let's look at the worldwide group balance sheet. If we just assume for the purpose of illustration, the Irish entity has equity assets of 1.3, but at a group level it's 1.4. That means we haven't disproportionately pushed debt into the Irish company, and therefore this says we should have no restriction at all. So, when you get within this relief, it's better maybe in some ways than the first relief because it's a full exemption, you're fully out. But again, that doesn't mean that in all cases the second option is necessarily going to be the best option for some taxpayers. So having done that, actually, Alan, I'll bring you back in just to wrap us up.
Thanks, Gareth. Yeah, we'll do this quickly so we've time for Q&A. I suppose just to bring all of that together, given the complexity, just to stand back and say, what are the main points? We think, not to sound like a broken record, but there's a window of opportunity now to engage on this in a meaningful way, to make the right points to finance, but also to think about this and the potential impact of it on your business in advance and to take whatever action is necessary. So modeling the potential impact, critical feedback, be it through us, through industry bodies, or directly to finance, are also really important. And it also strikes us that although the rules will be effective for 2022, things you're doing between now and the end of the year, such as restructuring loans, such as determining the appropriate allocation of external debt across various jurisdictions, will all have an impact in terms of how this regime will impact you. So there's 32 questions, right? So it's really tricky to capture responses to all of them. But if we were to say, look, what are our must-haves? It seems to us that the exemptions really should be framed really widely, because once this is on the books, it's on the books, and you can't widen it after that, right? So in particular, considering how we need to be competitive and to ensure that these restrictions are not a means of or an obstacle to achieving certain things from an economic and social perspective, and even looking at climate when it comes to renewable projects, etc. I think it's really important that the exemptions are framed widely. To the extent there are exemptions, they should be workable, because plenty of provisions introduced over the last few years do have exemptions, but it's really, really difficult in some instances to get comfortable that you can rely on them, and they're just not availed of. The group provisions, optionality, either earnings-based or balance sheet test, very important, because one answer will suit some businesses better than others and vice versa. And as we said, we think the directive does give you that flexibility. And the point that Gareth mentioned earlier by reference to the example, I think it was the leasing example around the carry forward provisions, not giving rise to a loss of capacity. We think that's really important as well. And then more fundamentally, a big ask, but I don't think it'll be acceded to this year, but I think you need to keep making the point, reinforcing the point that Ireland's regime now is going to be really complicated when it comes to interest deductions. We did have a slide that set out all of the provisions that apply, and we took it out because it was reaching 2 pages. It's amazing how much anti-avoidance and rules that we have around interest deductibility. And if you bring this in, you say, well, if we're achieving what we need to through this, the Irish base is not being eroded anymore, you have a general purpose test, why do you need all of the rest? Hand over to Tom.
Thanks, Alan. We have a minute, or actually we have very little time for some questions. There have been a number that have come through. I'll just briefly hit on a couple. One here, if there's a loan in place pre 17th of June 2016, but is revolving successfully with a new note issued every year, so technically repaid and immediately reissued, would this still be deemed pre 17 June 2016?
I suspect not. I mean, it's a good question. I think the way the directive is framed and the consultation presumes that it would not. So I think that's pretty unlikely that would get grandfathered in, certainly as things stand. I note there's a reference in the question that it might be a standalone entity, so you might get out under a different method there. you might get out of the standalone exception. But I think if you've got a revolving loan and it is being repaid every year, then there is uncertain. It seems unlikely. As we mentioned in the presentation, there is a question: if you've got multiple drawdowns and you start repaying some of them, is there an order of repayment if some of the drawdowns were pre and some were post? Which drawdown are you deemed to be repaid for those purposes if it's not clear from the loan documentation?
Right. Agree with that. Maybe one for you, Alan. Is grandfathering only related to interest expense, or is there a risk that interest income on a pre-June 16 arrangement may be disregarded in calculating the net interest income expense?
Yeah, that's a good question, because that would not be good. Yeah, so the document defines a grandfathered loan by reference to a loan on which there's deductible interest equivalent. So you just look at one side. So it's only loans that you're taking a deduction on and incurring expense on, thankfully.
Thanks, Alan. So look, we're just over the hour now, so we'll call it at that. It just leaves me to thank both Alan and Gareth for the time this morning, and also to thank you for your attention. I hope you found it worthwhile. If you'd like to discuss any aspects of the rule and how it might affect you or your businesses, please don't hesitate to reach out to your KPMG contacts, or indeed myself, Gareth, or Alan. We plan to host our next webinar under the Tax Leadership Series in March. We will be switching gears, picking up on the theme Alan mentioned at the end. It is going to focus more on environmental issues and the carbon tax agenda, and in particular the carbon border adjustment mechanism, which was highlighted by the EU as one of the areas that they were looking to fund various COVID supports. The Biden administration has also signaled that they are looking at something like this in the US. So it is likely that we're going to see a much broader reach of this type of mechanism going forward. And that could fundamentally change the cost of goods and materials, and drive more changes in supply chains. So invites for this event will issue in the next while, and we hopefully will see you at that. Until then, thanks again for joining. Stay safe and have a good day.